All right, so hello everyone. Welcome back to this new module where we'll be looking at weighted average cost of capital or WACC for this particular company. Just a brief recap here. We previously we had calculated beta, so we had gone through what is beta, how and where it is used, and how to adjust it, how to unlever it and relever it in order to use it for our comparable model, in order to make it more comparable for with other companies, and how we can basically then move on to calculating cost of equity, because beta is an element of cost of equity. Okay, so now we're just going to put the rest of the pieces together in order to calculate our weighted average cost of capital, which is this little number right here. And what it does is basically weighted average cost of capital is what you're paying in order to fund the company as a whole. To both. So this is one rate that tells me what is going out of my company in order to satisfy both debt holders and equity holders. And yeah, so let's look at how to calculate it. Since we calculated beta before, I think it'll be better for us to, out of the two components, to look at cost of equity. We'll come to the cost of debt after that. Okay. So, cost of equity is basically what the shareholders of the company expect to earn out on their investment. If they were to, let's say buy our stocks. So this basically is more based on expectation, unlike cost of debt, where you have a proper rate of interest that is specified right away. Here we are dealing with expectations. So our formula basically comes from sensitivity of stock market, which is the beta, and what is being earned currently at a risk-free level, and then how much the market or the index is paying. Again, this is the model for Western Carriers India Ltd, and it's a company in logistics sector. So let's just start right away. So as discussed previously, the method or the methodology that we have for calculating weighted average for calculating cost of capital is the capital asset pricing model. Under this model, we basically look at three elements: risk-free rate, beta, and the market risk premium, which is how much your index is paying more than the risk-free rate in the index or in the market. How much is the market as a whole generating over and above the risk-free rate, and that is called equity market premium. Okay, so this whole segment of RM minus RF is equity market premium. In order to calculate this, it's fairly simple and straightforward. We'll first look at the risk-free rate. So in order to calculate risk-free rate, you basically simply go to this website called as Trading Economics, and you look at India here, because this is an Indian company, and we look at interest rates. All right, so risk-free rates in India. Now, one thing I should mention, that if there were expectations of a change in this risk-free rate, so basically risk-free rate is something that the central bank of every country sets up. So they can change it. If they lower it, then it means that they are trying to stimulate the economy, because the borrowing rate in the country goes down as well in tandem. And if they increase it, that means that they are trying to control certain measures such as inflation, or they're trying to tame the overheating of the economy. So risk-free rate is that rate at which, if we were to lend our money, we would most definitely and without any risk get at least that much back. Okay, so we'll get at least 6.5% should we invest in the Indian government's bonds. This is not quite fully correct, because especially for cases like India, because India in itself is not a totally risk-free country. As we have seen with other countries, they have gone bankrupt on a country level. So on a sovereign level, if things can go bankrupt, then most countries are not totally risk-free. When we say risk-free, it is typically being spoken about for countries that are developed, like America, UK, Germany, etc. Okay. So, but in our case, we can make a small adjustment to this, but for the time being, we look at this particular rate. And let's say there has been a news in the market for this rate to change. There's a consensus expectation that RBI is going to lower the rates, maybe in response to USA lowering its rates. Then what we will do is we will simply use the lowered rate, because like it has been said before, this is an exercise in projection. So since we are trying to project something or estimate this future value of something, we need to make sure that all the elements that are used are based off of what will happen after, as opposed to what has happened in the past. Okay. So yeah, you look at risk-free rate and you select that. So you can put here 6.5. I have just made a small adjustment to this, so you can ignore the 6.7%, but here you can add your 6.5, and then you look at the return of the market. So this RM is basically return of the market or the index that we are talking about. In our case, the index was logistics index, which was created by taking the companies from Tijori. So as you may remember, this is what we had done, and we know that our 90% of our market was covered by up until TCI Express. So we did not take anything beyond. So this was of no use to us because their contribution was very minimal. So index, the market index, what it is paying us, we will simply look at the average of the returns that it has given back. So in our case, if you look closely, we have taken an average of the returns. Again, returns are calculated by taking the updated figure. So let's say I'm going down in dates, August price divided by July price -1, and then it gives you 2%. And similarly, we've calculated everything like that. So if you look, every formula here represents that, and then we take an average of these interest rates. That gives us the return on the market. So here, if you go back to WACC, this RM becomes the return on the market. So risk-free rate we found out to be 6.5% based off of trading economics, and then we've calculated the return on markets using index that we created. And then we take how much extra is the index paying us. So apparently the index for logistics is actually paying less than the risk-free rate. So if you really need to enter this market, you should expect the fact that you will not earn as much as the risk-free rate. And then we applied the levered beta here. So now that we know how much extra or lesser the market is paying, now we need to multiply that by 1.2. So we are saying that since market is paying, since the risk premium is -4.48, our beta enhances that reduction in expectation of returns. So by 20%, or if you multiply it by 1.2, that basically will say that, hey, multiply this with 1.2 and then reduce it from my expectations. So if I was investing in Western Carriers, I would expect a cost of equity at 1.37%. Okay, coming to the segment of cost of debt. Okay, this is the amount or expense that you're making towards debt holders. You are paying them in order to be able to get loans from them. So companies, of course, take on debt so that they don't have to dilute their ownership and instead just pay the money if they feel they can sustain the interest payments. And we look at how this is calculated. So here you'll notice that we've done pre-tax cost of debt, and that's basically the interest payments over at the total borrowings that you have, current and non-current borrowing in your balance sheet. So this comes from income statement, this comes from balance sheet, and this gives us the pre-tax cost of debt. Again, if you have another estimate. So since this company, Western Carriers, was recently listed, we did not actually have a lot of access to its documents, such as its bonds, etc. So we have just taken a simplified angle at calculating this. But in a lot of cases, as companies move forward, they start divulging information on what interest rates they are getting, or what interest they are have to pay in order to, borrow more money from the debt market. So if they do divulge certain such documents, you will look at those, and if they say that, hey, we moving forward, instead of let's say 8%, our cost of borrowing is going to be 7% or 5% or 15%, that is what you will put here. So if you see closely here, the note number, I've added a note that currently no data on bifurcation of interest loans. Hence, it has been assumed that on average, the cost of debt will be the same portion as before the pay down of debt from IPO fund. So in this particular company, it went through an IPO, and some of the funds it will be using to reduce its debt. But there is no indication from the company that, hey, once we paid this particular debt amount of debt, we will actually get loans at a cheaper price or a higher price. So we've simply used the cost of debt that or the pre-tax cost of debt that was being paid before the pay down. Let's look at the next element here is the tax rate. Of course, self-explanatory. I don't really have to go into this. So you will pull your tax rate from the financial model. As you can see, my tax rate has been pulled from financial statements. So how much the company paid divided by the pre-tax earnings. Here you have the finance costs that have been subtracted and EBT. And so basically, this allows us to calculate the tax rate. And next is after tax cost of debt. So see, when we were deleveraging the beta or deleveraging the beta, we had here the tax shield as discussed previously. So since tax is our expense, since interest is an expense or is counted as an expense, and it reduces the profits that we pay taxes on, this helps us in paying less taxes and ultimately allows us to make some savings. So this savings is called tax shield, and that tax shield actually follows debt everywhere it goes, or almost everywhere it goes. So here after tax cost of debt has been calculated. So when we say after tax cost of debt, we say, hey, our actual borrowing cost is 8.18%. But if we are paying 8 rupees on every 100 rupees that we have borrowed, our tax gets reduced by that, our profits get reduced by that 8 rupees, and we pay lesser tax. So after tax cost of debt then comes out to be pre-tax into 1 minus tax rate. Okay. So there you have it. That's our cost of debt and that's our cost of equity. Now that we have both elements, let's see how we will integrate them to calculate weighted average cost of capital. So for that, we come to capital structure here, because we cannot simply average them out. This is representing a different portion of the capital that the company has raised, and this is representing a different portion of the capital that company has raised. So what we will do is we will look at the capital structure here. So total debt is 269 crores and market capitalization, or I think this was in crores. Yeah, okay. And market capitalization is 1554 crores, which makes the current debt equity ratio in these proportions. So this is the total debt. Debt represents about 15% and equity represents about another 85% of the company's capital. But we know from our readings of the financials that this company is going to go through an IPO, and some of the funds are going to be used in the pay down of debt. We can either look at that particular paid down version of capital structure, or we can basically look at mature companies and see, okay, where is the mature company and what is the debt equity ratio that they have. In my case, I've looked at what will happen to the capital structure once the debt is paid down. So once that is done, debt will only represent about 6%, and then market capitalization will represent another 94%, making up the 100%. So how do we apply this in our calculation for cost of weighted average cost of capital? So we look at cost of equity, we look at the weight it is going to have in the capital structure going forward, then cost of debt and what the weight of debt capital is going to be moving forward in our capital structure. All right, so we've arranged them here. So 1.37 here, equity weights here, debt weight here, and then we look at we basically are doing applying a sum product formula or a sum product function, or you can simply just manually do it like I have. So cost of equity into weight of equity, and then multiply the and add the product of cost of debt into the weight of debt, and that gives us the weighted average cost of capital in this particular format. You must have noticed that there is a section here that has been ignored, which is basically industry median leverage beta. So for all the peers that we found out, we actually calculated the beta for all of them and then unlevered them, and then relevered it based off of our company's debt structure. So we looked at unlevered beta, okay, and target debt to equity is 6.16. Yeah, and so this is basically done just as, you know, a comparative measure, that comparing the median or the very center point of the which is this the very center point in terms of unlevered betas or pure betas, which are do not have any impact of individual capital structures. We wanted to see what is the very median, and if we were to change that median to our company and have it affected by our company's debt equity ratio, what will it turn out to be? So you can see it's not too high, too much higher than what the median currently is. So from 0.63 it has gone to 0.79, but nonetheless our beta in itself is 1.2. So we've used that for calculation of cost of equity. This is just for reference in case moving forward you need to check something, or you start to feel that this is more feasible for making a projection for the future. So that's there. And the way we've calculated it is very similar to how we did it in the case of our own stock. All right. So like we did it for the stock here, you simply calculate it for every stock there. It's not too difficult, so don't be overwhelmed just by looking at too many numbers here. This is just the same thing. I arranged the data of the index here, the stock prices here, and then the returns of index here, and the returns of each of the stocks here. So you can see it's just the same thing that we did before, right? And we just basically calculate the averages as well, just to observe what's going on, if there is a trend or something like that. And then we've calculated slopes or betas of every company here. Okay, so levered raw beta. So before it is adjusted for the beta drift, it is called levered raw beta. Once it is adjusted, we call it adjusted beta. Again, adjusted beta is something that based upon research, we hope that our betas will move towards 1 or get in line with the index. So that is why we have to adjust it for by a certain percentage in order to be able to predict the future. Okay, so I hope you have now understood how to calculate weighted average cost of capital, and moving forward you'll be able to create these schedules. All right, I hope you have a great day, and I'll see you soon.